What if tomorrow you woke up to the headline, China's economy has collapsed? Not a slowdown, not a hiccup, but a full-blown collapse. How would the world react? Would you pay more for food and energy? Would Wall Street crash overnight? And who would benefit from the chaos? Today on Econ Barbarian, we're diving into one of the biggest what-ifs in global finance. What happens if the world's second-largest economy suddenly falls apart? As of mid-2025, with China's growth slowing to around 4.8% in 2024 from 5.2% in 2023, and projections for 2025 dipping to 4.5%, these scenarios feel less hypothetical amid ongoing property woes and demographic pressures. China's role in the global economy. First, let's set the stage with the latest figures. China remains the second-largest economy, with a GDP estimated at around $18.8 trillion in 2024, up slightly from $18 trillion in 2023, though growth is decelerating amid structural challenges. It commands nearly 15% of global exports, totaling $3.58 trillion in 2024, making it the largest exporter worldwide. As the biggest trading partner for over 120 countries, its influence spans continents. It's the factory of the world, producing everything from iPhones to t-shirts to toys. Simultaneously, it's a voracious consumer of raw materials, snapping up over 70% of global iron ore imports and accounting for about 15% of world oil demand, though recent data shows oil demand plateauing due to electrification and economic headwinds. China also drives demand for critical minerals like lithium, up 30% in 2023, for EVs and renewables. Put simply, China is not just another economy. It's the central gear in the global machine. If that gear breaks, amid slowing domestic consumption and youth unemployment surges, the entire system grinds to a halt, potentially shaving 0.51% off global growth annually. Why would China collapse? A total collapse is unlikely, but let's imagine the conditions, updated with 2025 realities. 1. Debt crisis. China's total debt has ballooned to around 310% of GDP in 2024, up from 299% in 2023, encompassing households, corporations, and government. If defaults cascade, exacerbated by local government hidden debts, banks could freeze, echoing Lehman Brothers in 2008. Recent IMF reports highlight this as a key vulnerability. 2. Real estate implosion. The property sector, still 25 to 30% of GDP, is in turmoil. Evergrande, the poster child of the crisis, was delisted from Hong Kong's stock exchange in August 2025 after defaulting on over $300 billion, marking a milestone in the meltdown. Country Garden reported smaller but still staggering losses, around $2 billion in interim 2024 profits, as home prices continue sliding despite stimulus. A full collapse could erase trillions in household wealth, freezing credit and consumer spending. 3. Demographics. China's population fell for the third straight year in 2024, with deaths outpacing births. UN projections show a drop to 1.3 billion by 2050 from 1.4 billion today, potentially losing 200 million workers by mid-century amid rapid aging. The working age cohort, 1659, shrank to 858 million in 2024. Raising retirement ages from 2025 won't fully offset the drag on growth. 4. Geopolitical isolation. Escalating trade wars, sanctions over Taiwan tensions, or U.S. tariffs could isolate China, shattering its export model. With Trump-era policies potentially reviving in 2025, this adds fuel to the fire. Any one of these alone is serious. Combined, they could bring the system to its knees, with analysts warning of deeper deflation if exports flood domestic markets. Immediate global reactions. If China collapsed, markets would panic instantly, as seen in hypothetical models from think tanks like Bruegel and Deloitte. Stock markets. Expect a global sell-off, with the S&P 500 and European indices down 20 to 30% in days, amplified by China's 30% weight in emerging markets indices. Currencies. Safe havens like the US dollar, Swiss franc, and gold would surge, while the yuan plummets. Commodities. Oil and metals would initially crash as Chinese demand evaporates, iron ore prices already down 20% in 2024 due to weak steel demand, but food and energy prices could later spike due to supply chain disruptions and rerouting. Trade. Shipping lanes from Shanghai to Los Angeles would go quiet, causing shortages of electronics, clothing, and medical supplies, with global trade volumes dipping 2–3%. For ordinary people, this means shelves half empty, higher prices, potentially 5–10% inflation spikes, and uncertainty about jobs and investments, especially in export-reliant sectors. Who loses the most? 1. Export-dependent economies. Australia. Over 42% of exports, $211 billion in 2023, to China, mainly iron ore and coal. GDP could shrink 2–3% within months as demand collapses. Brazil and Chile. Brazil sends 28% of exports, $188 billion, like soybeans and iron ore. Chile's copper market would tank, devastating commodities. 2. Multinational corporations. Apple. $67 billion in China sales in 2023, with supply chains disrupted. Tesla. Shanghai Gigafactory remains its biggest hub, risking production halts. Nike. China accounts for 15% of revenue, broader hits to firms like Samsung, now shifting laptop production to India. For these companies, losing China would mean tens of billions wiped off the balance sheet. 3. Global investors. International funds hold hundreds of billions in Chinese stocks and bonds. The MSCI Emerging Markets Index, where China represents nearly 30%, could fall 20–30%. Pension funds in the US and Europe would suffer immediate losses, with ripple effects on retirement savings. 4. Ordinary consumers. Cheap electronics, solar panels, and clothing would become scarce. Inflation would rise globally as companies scramble to replace Chinese supply, potentially adding 1–2% to household costs amid weaker global trade. Who could benefit? 1. New manufacturing hubs. Vietnam. U.S. imports hit $97 billion in 2023, with 7% GDP growth from 2018–2024 driven by supply shifts. It's now an electronics powerhouse. India. Surging in pharmaceuticals, textiles, and electronics, with companies like Samsung expanding facilities. Mexico. Nearshoring. Boom with proximity to the U.S., attracting investments amid global diversification. These countries could absorb a wave of supply chain relocations, becoming the new China in select industries, with Vietnam and Mexico seeing manufacturing investments double in recent years. 2. Commodity exporters. Initially hurt by collapsing Chinese demand, but long-term, they could redirect to other emerging markets like India or Southeast Asia. U.S. agriculture could find new buyers for soybeans and corn as global supply chains reset, potentially boosting Midwest economies. 3. Geopolitical rivals. The U.S. and EU would gain leverage, accelerating China plus one strategies and reducing dependency. Countries in Southeast Asia could rise as geopolitical middlemen, attracting both Western and regional investment, with ASEAN growth projected at 5% in 2025. The global domino effect. The collapse wouldn't stop at China's borders, it would shake the entire financial order. The World Bank estimates China contributed 30% of global growth in the last decade. Remove that, and the world risks recession, with 2025 global growth slashed to 2.3% amid trade tensions. Debt stress could spread to emerging markets tied to Chinese credit, like those in Belt and Road nations facing defaults on infrastructure loans. Political instability could rise across Africa and Asia, where China funds projects. A slowdown could halt $1 trillion in investments. Even the United States wouldn't escape. While some industries might benefit from reshoring, Wall Street exposure to Chinese assets means American investors and pensioners would feel the shock, potentially halving U.S. economic output growth by mid-century in extreme scenarios. A fragile balance. So, is China's collapse likely? No. Beijing has tools, capital controls, state-owned banks, and trillions in reserves to prevent total implosion, as evidenced by 5.3% GDP growth in H1 2025 despite challenges. But here's the truth. The question is not whether China collapses, but what happens if it slows down severely. Even a 3% growth rate instead of 6% could slash global growth by 0.5 to 1% annually, with risks of deflation and muted consumption persisting. For investors, businesses, and everyday people, the lesson is clear. The world is dangerously dependent on a single economic engine. If that engine misfires, amid headwinds like inadequate demand and Trump-era uncertainties, we'll all feel the tremors, urging faster diversification into hubs like Vietnam and India. Stay curious, stay sharp.